Everyone, good afternoon. We're going to start getting the show on the road here, and I'm here happy to introduce Aaron Tilton, the CEO of SmartFi. SmartFi is a lending platform, and also you're the president and CEO of Blue Castle Holdings. So Aaron has had some exposure in the energy policy area, which will make some interesting reference to the mining elements of crypto that are so complex and difficult for most of us to understand. But more importantly, what we're going to do is launch our discussion by letting Aaron share a little bit about what SmartFi is, how it coordinates with the whole crypto landscape, and we'll delve into other questions as we go along. Aaron, welcome.
Thank you. Thanks for having me. We get these kind of this same comment you had before about how cryptocurrency seems to be complex, right? And I think that's kind of a common theme where everybody's, gosh, it sounds hard or difficult, complex, and all the new terms and everything go along with it. But I think one of the things that we do at SmartFi is try to make that simple. And it is relatively simple if you understand some terms, a few definitions. And that's really kind of how we got into the space in the beginning, because we didn't know anything about it either. Right?
How long have you been in the space?
So 2017, we started getting these calls from cryptocurrency miners. And at the time, we were running an energy business, and they were looking for electricity. And so when you think about Bitcoin or cryptocurrency networks, they all have to have electricity and computation to run, right? That's the backbone or the infrastructure. I know Caitlin Long was talking about infrastructure of crypto. And that's really what a cryptocurrency network or a blockchain utilizes in terms of computation. And people think of, like a big data center and all the electricity that's used. And so it's similar to that, but it's decentralized. So you have computers all over the place. There's no real coordinated effort or coordination between who runs those networks. Anybody can do it, right? That's kind of the beauty of Bitcoin and crypto in general, is that it's something you can participate in without having permission, right? And so how we kind of got into all this is in 2017, started getting calls from people looking for large-scale electric infrastructure, which is what we do. We have another project called the Blue Castle Project, and the main goal of that project is to build a new nuclear power plant in Utah. And so we've been running that for years and spent a lot of time, energy, and effort into that. They thought that was running, and that's probably multiple marathons. It's a decade or two in the making, right? So we had to tell them that there's no electricity available from there. And we started helping them find those resources around the world. And so we started learning about what is Bitcoin, what is crypto, and why do these guys want this energy. So that was kind of the beginnings of how we got involved.
Fascinating. And so you say in your descriptive that SmartFi combines monetary policy with crypto to create a sustainable lending platform. What does that mean? What can you share to help us understand that better?
Yeah, so what we learned in the first year or so, it was hard. It was difficult. Back then, we were using hardware wallets, little thumb drives, basically LED screens and clicking here. We would be sending or receiving Bitcoin from China, from the UK or South America. And these were companies that were building infrastructure, these data centers. They're really not data, they're computation centers. They build hash rate, is what it's called. And you would send $20 million worth of Bitcoin on this little thumb drive. It was terrifying. Right? It was because it's like when you send.
So they would be sending you $20 million worth of Bitcoin.
Either send it to us, or we'd be sending it back to them.
Okay, so you would be the middleman. You would be
Not the middleman. We were the end source. They would give us Bitcoin, and we would lend them dollars against that Bitcoin.
Okay.
Right. And so in this process, you learned that the average person was not going to have a reasonable time figuring this out, right? So SmartFi was the effort to simplify this process and take what we learned at the institutional level and the energy level, or the base layer level of commodity networks for crypto, and make it simple for people to understand, right? So a lot of people maybe recognize maybe like Coinbase, or like Robinhood, in some of these cases, these are centralized brokers for cryptocurrencies. So we built one of those, but we didn't want to just be a Coinbase or another broker. We actually been building a blockchain to structure a cryptocurrency network that utilizes dollar-denominated stablecoins. All right, so that makes it simpler for people to understand, kind of like Venmo, right?
So a dollar-denominated stablecoin, is that the SmartFi token?
There are actually two tokens.
Okay.
So
you have a SmartFi token, two elements of that.
Yeah, and that's one of the things that we learned, that when Caitlin Long was talking about this, and the other gentleman, I can't remember his name, that had the book.
John Tammy.
Okay, John. They both talked about volatility is not good for a monetary system, right? You want it to be super stable. But what attracts people to crypto is the volatility, right? Where they think that they can catch lightning in a bottle, right? So they all want to benefit from it. But then once they have it, like these miners that would mine for it, they would have this asset that they couldn't monetize, or they can't go to the utility and give them Bitcoin to pay for the electric bill. So they had to come to us, and we would lend them dollars against that Bitcoin, or whatever their currency is. They would then convert it to, whatever the fiat currency of that country was that they were in. So that's how we kind of started this and built that. So we recognized you need two currencies. You need a stable one, and then you need a volatile speculative coin to drive speculative use.
And so early on, your stable coin was backed by US dollars, US treasuries.
Well, so currently right now, that'll be a release next year. We started with the speculative coin first, because that's, again, what drives user adoption, right? So that was released last year, started around 70 cents, went up as high as $4, and is back down about $1. So that process is proving to play out, with the market. It's correlated really a lot to equities.
So the relationship that you really have is primarily with the miners. Is that safe to say? So that's really your target audience.
Yeah, that was our key constituency for sure. And they're the little known backbone to cryptocurrencies. There's probably not hardly anybody in here that can tell you what mining is, right? But it is essential. And Ethereum has now made a move to staking, and we don't go into all the details around staking, but there's some fundamental shifts around whether or not that core competency in either mining or staking will have a regulatory impact. The SEC has made some comments about that, what they call it was basically a merge from mining to staking. And they used to kind of give these indications that Ethereum was not going to be a security. Then they made some statements about staking really looking a lot like an investment contract, so they might come under SEC scrutiny and be deemed a contract, because it's basically, all you have to do is put your coins, stake the coin on the network, and then you're going to receive a payment.
Right. Well, I'm going to back up a little bit so that people in the room get a better understanding of mining and how that works and how it's grown. And also, number two, what regulatory influences you might have needed to convert Bitcoin to dollars and that type of payment function. So the mining issue, I know most people in the room probably would love a simple version.
Yeah, it's pretty easy when you understand the term. So mining is just a nerdy way that the groups that built the Bitcoin network, there's some ambiguity as to who they were or who he was, right? And Satoshi Nakamoto was a pseudonym for either a group or group of people
that invented Bitcoin.
Yeah, they wrote the white paper and invented the network. So mining is, if people could just think about it, it's really just accounting, right? So if you go to a bank, you put money into a bank, they provide two services, right? They provide one, which is privacy, supposedly, right? That you've got this account, right? They also provide security, right? And then they also do the accounting for you, like your ledger on your checkbook. And that's what miners do on the crypto network.
Are these all, they're computer programmers? So they're programming billions of different calculations to build a block?
So a few differences
on the
there.
ledger,
Yeah,
yes.
so the way that it works is a blockchain is nothing more than every 10 minutes, in the case of Bitcoin, there are a certain amount of transactions. So if this was like your checking account or your credit card, every 10 minutes you would accrue so many transactions. And then those transactions need to be added to the balance. And so it's either going to take away or add to the balance of your bank account, right? So Bitcoin is the same way. You have an address and you have an account balance. And on the total network, it's every 10 minutes of these a block of transactions come in, and then it stops, and somebody, one of the miners, provides, I don't want to get too jargony, but a cryptographic hash in terms of SHA-256 algorithm, right? It's a security algorithm invented by the military. And when you solve for this problem, you then get the right to record the transactions, or they say, hey, you're the accountant for this 10 minutes in the network. So you get to record these transactions, and we're going to pay you. Currently, the block reward is 6.25 Bitcoin. And that's as simple as mining is. They're really...
And so why is the energy usage of Bitcoin sometimes to mine Bitcoin equated to the energy usage of small countries? Why does it take so much energy?
It's a big network, right? It's probably the largest supercomputer in the world at this point, right? As each node or server has a copy of the same accounting ledger, right? So it's in that way it's decentralized. If half of the servers blow up or get taken off the network for some reason, all of these other computers still have the same information. It runs without interruption, right? But the scale that provides the security under this protocol called proof of work, right, is what provides the security. Because if you tried to hack the network, you would have to recreate all the work from the blockchain all up to that point, plus you would have to get 51% part of the consensus mechanism. And now we're getting a little jargony, but it just means that 51% of the computers agree on what the transactions should be for that 10 minutes. And that's when they record the block. So every 10 minutes, they add a new block. So it's like a 10-minute snapshot of the transactions to add block to block to block. And that's what's added on the network.
So this is why the blocks are secure and why it's so difficult for perhaps a hacker to come in and create a pretend block?
Yeah, and there's so many people doing it, you have to get a majority of the consensus from all the servers. So you would have to basically spin up, probably in the nature of like 10 nuclear power plants, right? And you'd have to have billions of dollars worth of servers to trick or to create a divergence in the blockchain to now say, here's the valid block, everybody adds their block to this chain. That would hack the network. But it's so big, now you're talking nation states that would try to intervene on that. But to what point is, if you hack the network, then what does everybody know about the network? They're not going to use it, and all of a sudden all the Bitcoin becomes worthless. So there's no incentive to hack the network.
I see. And so you mentioned this, so this is called proof of work, and Ethereum, which is the other currency and blockchain network, just had their merge, and now they call it proof of stake. So what is the difference? Because people will be hearing a lot about Ethereum and Bitcoin and the differences.
It goes back to your earlier question about why is electricity important. So in this process, you have to have electricity to run the servers, and then you have to have the servers themselves to do the computation, right? And that puts something at stake. If you're a miner, that's what you have to lose, is the investment that you've made in servers, the facilities, and everything that you run the network with, right? And it's work. I mean, it's pretty simple, right? That's the work they have to do. Staking means you take the same asset of the network, like Ethereum, and you stake it in a wallet, and it doesn't do anything. It just sits there as proof that you have something at risk. And you don't do any real work, right, other than you put assets at risk in the form of Ethereum, so you had to acquire that Ethereum somehow. You either bought it, mined it, whatever you did to acquire it. And that gives you the right to then record transactions like on proof of work, but it's a staking model, which means the electricity consumption, the commodity layer of that network is drastically reduced. But it means it can centralize control to anybody who puts more at stake, right? So when they first did the merge, if I remember correctly, there was about 60% of all the assets were controlled by 3 major players. That's not very decentralized, right? So the concept
In Ethereum, you mean?
in Ethereum, yeah. Yeah, and so when they did that merge, now it's getting a little more decentralized.
Who were the 3 major players, if I may?
It was Coinbase and a few others, I don't remember exactly.
Okay.
But they basically with just value that they put into play, through just funding a wallet, they control the consensus mechanism for the network, which basically says these are valid transactions. That's pretty scary to do, right, on a network that controls these transactions. You want to have something that's very decentralized when we've been talking all about governments and control and all of these other things with crypto. Crypto is supposed to be about individual control of your property. And now you have basically 3 entities that could control whether or not you could use your assets.
I see. And so then what would happen was you basically provide a platform for all these miners to get payment for their work. You would give them dollars for Bitcoin.
Yeah, we would actually make them loans. So we're a non-bank lender. So they would give us Bitcoin or Ethereum, and we would give them, say, 50 cents or 70 cents on the dollar. And they would go pay their electric bill, go pay whatever they needed to, because the assets are volatile, right?
Right. Well, that's my next question.
Yeah.
So Bitcoin has a volatility that's 6 times that of the S&P 500 index.
Yeah.
It's huge. So how would you protect yourself if you're lending against Bitcoin collateral?
We had something very similar to securities-backed lending, which somebody gives me Bitcoin, we set a margin level. So that's why we had 30%, maybe 50% of reserve, depending on who was doing the borrowing. And if the value went down at a certain level, it triggered the requirement for them to send us more Bitcoin, right? But if it goes up, we would send more back to them. So we would maintain that margin periodically, depending on how much volatility there was. And that allowed us to provide some security and safety for the miner, and it allowed us to have the same kind of security and safety.
So as you see this moving forward, Aaron, again, this is it's still a complicated topic and area for most people to understand, but I guess it's like the infrastructure working of telecom or even the electricity grid, right? Most people don't know how the electricity grid really operates. So how do you see it scaling in the future? Significant scaling in the future is what we're projecting here. And how do you see this playing out on your side of the infrastructure platform?
Well, one of the most interesting things is kind of about this staking versus mining, right? And a little bit of, you heard Caitlin have a different opinion about Bitcoin was going to be what they call a maximalist network, right? And the other gentleman said that, it's going to be Netscape, right? And I think what's kind of true to form is that you're going to have a modification of both. And we have a protocol that we're experimenting with. And it's not new, but the application, the way that we apply it is new. But like all things, that we're basically copying something that somebody else did with their software and then giving it a new application. And it's called merged mining, right? And that's where the stablecoin network comes in. It's coming up next year, right? And basically the way that it works is that you can use one computer to mine for 2 networks. And you use a protocol that allows you to basically merge mine. So what it does is now, whatever the electric costs were for the Bitcoin network or whatever network you're going to merge mine with, ours in particular is Litecoin, you can secure another network with the hash rate of the original network and not have any more cost in the form of computation or electricity. So if that other network grows to the same scale as the other network, you just became doubly efficient, right? So the question of whether or not electricity is a good use in terms of blockchain and crypto technology, we think it makes eminent sense. Because, well, one, regulatorily, the SEC says, hey, if you're going to just basically pay people for staking, that's either a banking function or a security, right? And you got to register that. So from a practical standpoint, mining makes a lot more sense from regulations, right? But also from an efficiency standpoint, there are technologies that you can employ that have the same effect as staking, but have more decentralization and align themselves more with the ideology of crypto.
So for people that don't know, how many cryptocurrencies are there? We talk about Bitcoin, Ethereum, you just mentioned Litecoin. How many cryptocurrencies are out there now? And do they all have to be mined in the same way? Are they mined in the same way?
Yeah, I don't think anybody actually knows that number because every day they're
20,000,
Yeah,
10,000, the number changes a lot.
Yeah.
There are thousands.
I would say at this point we're approaching 20, 30, somewhere in that neighborhood, and it's going to continue to grow. But the difference in cryptocurrencies is significant. You have native protocol coins, which are native to a network like Bitcoin or Ethereum. Those are native protocol. They're used on that network. But Ethereum has a smart contract structure enabled so that you can issue other coins that are not native or not used in the payment system for Ethereum, but they're like ERC20 tokens, right? Or Binance has a BEP20 token. So within inside each ecosystem that has a smart contract enabled layer, there are thousands of other coins that are issued, and you can just spin them up, within minutes.
I mean, do you see that as extremely risky for people that don't really understand the space? And how do you see that being regulated, in the future? There's so many people that just don't know what basically the risk factor in many of these issues.
Yeah, it would be something like penny stocks,
Okay.
right? So you've got kind of your, Dow blue chip stocks. Then you would have, thousands, maybe tens of thousands of very obscure coins or tokens that are basically being traded for some either utility or just speculation. And right now, a lot of those, in fact, most of those would fall under the jurisdiction of the SEC, right? For native protocol coins, you're going to be looking more like the CFTC because they classify tokens as commodities, right? And so if they pay out under the basis of the Howey test, the four-prong of the Howey test, right, then that would be considered a
Can
security.
we explain what the Howey test is for the audience?
So there was a court case that basically involved oranges and orange groves in Florida that was being disputed about whether or not somebody could just put up money, receive an interest payment, and that was an investment in a business, or was that a security contract created, which would then be regulated by the SEC? So they came up in this court case with 4 prongs or 4 tests that basically if you met these 4, or in fact if you only had one of the 4, you were not a security, right? So it's just a test of these.
And what are the 4 prongs? Do you recall?
It was an investment in a business, right? And then there was a expectation of a profit.
Right.
And if the management was engaged in the management of the business and there was no work or effort, I don't remember what the third was.
Right.
Somebody will remember, will remind us.
Right, exactly. Well, terrific. So you say you've completed $1 billion in loans and transactions. So
Yeah.
these are all with the miners that you've been working with.
Some are just small businesses that
Okay.
deal in crypto,
I see.
right? So we've done some interesting ones that we funded, a private jet app. So there are people that can buy private jet time with crypto, right? And they convert it. So this group came to us. It was a super interesting story. The guy, I think, is worthwhile because a lot of people when they're here, they're like, "How do I benefit from crypto?"
Right.
Here's a good example of a guy,
the
the
use
average
case?
guy.
Yes.
Yeah. This was a guy that installed audiovisual equipment, and then back in 2011, somebody talked to him about Bitcoin. So he started buying $400, set aside $400 from his paycheck every month, buying Bitcoin. His first Bitcoin he was buying at $3. So you can imagine what happened to his portfolio over time. But he was doing $400 every month for years, right? And by the time we met him in 2018, that was worth, $500 probably $10 million at that time, right? And then over time, it got to be more. So he brought Bitcoin to us. We would convert it to dollars, and he had 4 or 5 companies he was putting those dollars into. And we'd help him fund that. Then they actually created their token. We helped him create the token. And so we kind of have like somewhat of a full service suite for somebody like that, where we helped them create a token, or they created that, but we listed it on our exchange. And then also we funded 4 or 5 businesses. He's bought homes, boats, all kinds of stuff from the lending that he does, and then uses it in his business, right? So his homes are second homes that he'll either rent out or do something with. There's a commercial purpose for those loans, but that's kind of what happens. So it's a good example of just this average guy. Dollar cost averaged into crypto, and over time, the market averages worked for him.
Now you mentioned the lending facilities that you have based on Bitcoin. Do you see banks competing with your business, or who would you say are the competitive elements that are either existing or might spring up?
It's mostly institutions right now, right? Hedge funds. In fact, we have a network of counterparties that we use to be more capital efficient. Instead of funding everything out of our wallet, we'll take that, rehypothecate, amongst a group of institutions that we think are doing it right. We can talk a little bit more about kind of the collapse of Celsius and all these things,
right.
In the summer we can talk about. But the OCC determined that banks can't hold crypto, but they can't put it on their balance sheet, so they have no financial incentive to utilize it in any of their products, right? But they can custody it. So we're actually doing an interesting partnership with a bank right now. So there's a state chartered bank that has begun to basically provide us with certain banking services, and then we're basically becoming the front end to their crypto side, right? So they stay in the banking space, we stay in the crypto space, but we're working in concert to help them receive deposits. So a lot of our clients will get accounts at that bank, and then
with the dollars that they borrowed from you.
Yeah, and then they can disperse those through the bank or through our platform, depending on what they're doing. And so when Caitlin was talking about, what she saw, what she's doing with their vision with building a crypto bank, I do think that that's certainly going to be happening, and you can see but it's taking a while, right? It's difficult. So I think the interim step is like everything else. There's going to be consolidation, acquisition, partners, strategic partnerships, like we're doing with this bank and then our platform, where we stay both within our lane, but together we do better. And so this state charter bank, which typically only takes in deposits from local community members, mostly businesses there, and we're now onboarding clients from around the world to this bank, right? And so when they talk about the difficulty that community banks are going to have adapting to this, here's the partnership that shows that those who adapt are going to take advantage of the early adoption.
I see. So another revenue stream
for sure.
these smaller entities, as you mentioned, could emerge out of this whole.
Community banks, if they embrace it, they can do the same things that we're doing. But they have to have a partner like SmartFi or some other entity that has the crypto experience. That's kind of the difficult part when you go to a community bank. You have no idea what to do with this, right? They're so focused on what they're doing. So it makes sense for a company like ours to partner with a bank. They can help us with certain things that we do to enhance our payment systems, in the eventual migration and evolution to decentralized money.
And so how do you see the decentralized money playing out here? I mean, if I were to give you a big picture, the magic wand, how do you see this all shaking out?
Well, you kind of already have that. I was talking to the head of the Bankers Association in the state of Utah, and we were having this conversation. It was like, he said, most people don't really realize there aren't really dollars per se of a specific, the Federal Reserve. When those deposits go into that bank, it's that bank's balance. Those are really technically those bank dollars, right? And so it's really segregated already because it's now a digital asset. So we already made half that leap, and it's represented in community banking. But now making the next leap, and what we do with our stablecoin network, people will be able to mine the interest from our loans. Right now, mining is paid through fees and a block reward for a payment system. We don't think that people should be charged to use their own money. that when you read our kind of thing about our, the monetary policy,
Right.
monetary policy with no fees. We think that's where it's going, because when you disintermediate, it has to be more capital efficient, and there has to be a benefit for the user, right? So when Caitlin talked about long distance bills, right? You're going to see that similar effect happening from the community bank level, where they'll no longer be able to charge fees because it won't be as ubiquitous as it is. And you're already seeing that with the fintechs, right? As they start moving around, they advertise no fees, and all these other things. But the next leap, at least in our estimation, is when you have a stable coin with no fees, but then you have a speculative coin that you can issue to a customer so they can benefit from the speculative value of participating in a bank, right? And that's what we're basically doing with this bank. If our customers leave their dollars on our platform, that goes into the FBO account at the bank, but we reward them with cryptocurrencies so that they can actually benefit from the speculative value. So as a customer, you're no longer looking at like a zero-sum transaction where you pay money to have a banking service. They'll actually pay you to put your money there in a more than a nominal thing that they do now. This is essentially nothing, right? So that combination of the only reason people get into crypto, make more money, right? That combination is now being extended.
No question. Well, Aaron, thank you so much for this overview and a sense. It's complicated. I know the mining issue and the platforms and the multi-functions that you've described that can engage the banking community. I'm going to open it up with the time we have now to any questions, if anyone has any questions or thoughts.
Yes, you mentioned that one of your coins, you said the price of it was closely correlated with equities, and that's dropped so much. But at least my initial interest in cryptocurrency, especially Bitcoin, was hearing it billed as a stable store of value, a type of digital gold that would protect against inflation. And yet, when inflation first started rearing its ugly head, most seriously last fall, crypto peaked and then dropped precipitously in line with other asset classes rather than being what it was built for. Why do you think that is?
Well, when we talked about the commodities that go into the network and the structure of capital, right, it's really a function of capital. So Bitcoin is really, I need to tell you this, there's not many people that use it for its intended purpose, which is the payment system, right? They use it to kind of capture lightning in a bottle, right? Where they want to run it up, and get 10x, in some short period of time. And there's structure to that. There's a reason for that. The protocols and the network and the software provide that. It's called the halving. Basically, it's the deflationary mechanism that's supposed to act like gold if you were mining it, right? That's where the term mining comes from. But all the cheap capital that's been flooded into the market across the world over the last 15 years since 2008 have done the same thing to equities, right? That cheap capital has been injected in speculative ventures, whether it's stocks, startups, in particular crypto, right? And so it adopted that same correlation because of the capital structure. When you have a network that is built on credit creation, you heard that term a couple of times when Caitlin mentioned that. She said, where's the credit creation going to be coming from? So if the Federal Reserve is creating credit by printing money, eventually you get inflation, right? Like we're seeing now, right? It's just flooding the market with this. There's no real credit creation associated with Bitcoin. It is speculative. So when you look at what goes on with Bitcoin, on average, 20% of Bitcoin is what's traded daily in the markets. 80% sits in wallets. So when the price of Bitcoin is being traded, people are extrapolating their value. It's unrealized P&L, if you were talking about trading terms, right? That Bitcoin sitting in a cold storage wallet is worth the same as what's being traded on the network or at an exchange. It's not true. It's unrealized, right? But it is a credit creation function that's tied to capital formation. So if the capital is being formed alongside the Federal Reserve, what happens to inflation with Bitcoin? does the same thing. It's an inverse correlation. Bitcoin goes down because it's designed to deflate up.
So,
Right.
to sum up, it's more of a risk asset than it is.
Absolutely, it's a commodity.
Or a stable store of
Yeah.
restricted value.
One of the things we noticed early on when we were dealing with it, it looks like commodities from the oil and gas industry. Think about the volatility in oil and gas. It functions very much the same. These servers and the commodity layer network for Bitcoin have a decline rate just like oil, right? Because they last for a certain period of time because of certain protocols in the network. And that's where we basically structured these forward contracts to help these miners get beyond their cash flow. It's exactly what we did in the oil and gas business. That's where we kind of built that strategy from.
Question, is Bitcoin and Ethereum, are they competitors or, I guess, enablers or helpers to the notion of central bank digital? And I know they're having a block on CBDCs later, but just curious about your thoughts.
Well, they're really two different things, right?
In other words, like, does the Fed crush crypto when they roll out CBDC, or do they play nice with it?
I don't think so, because people are really using crypto for its utility, are looking for privacy, decoupling from the government, So it's how we were able to fund stuff in China without actually having anybody on the ground in China. Didn't underwrite a single loan. We just received the asset and moved it, right? And so it opens up a lot of that economic basis. The CBDC structure will still have KYC. We'll still have a lot of BSA compliant, because it's all going to be funded through either local banks. The local banks actually don't like it, and that's probably the competitor to the CBDC. Is the local bank now can get basically removed from the direct-to-consumer as a money as a service business by the Fed. That's where they really have to worry about that.
So thanks for this information, and your organization and the likes. What are the obligations on your ESG reporting, if at all?
So I think the structure around what we do, right, the decentralized nature of it, is really not reporting anything as it relates to ESG. We look at that as like kind of a social engineering mechanism from governments or for advocacy groups to basically control economic import or creation. And cryptocurrencies in general are opposed to that.
Are there any altcoins or currencies that you're looking at right now that have the potential to reach an Ethereum type level of acceptance, market penetration?
I'd be so biased if I told you what it
Well,
was.
you have one, but you see any others on the horizon that are going that way?
I would say any crypto that improves on the friction already existing in crypto, right?
By friction, you mean volatility?
Well, I mean
Or
transactional utility.
Usability.
Yeah, and so if you're increasing the user experience and making it more favorable, that's really what you have to look for, because crypto is really running around utility, right? And especially when it comes to regulatory constructs, there are lots of cryptos that can, wildly appreciate. But as soon as they get attention from the SEC, they may be deemed as a security like XRP, right? Now we know that that's moving through the court, through their process and the appeals and everything. But XRP became very successful and it was targeted. And when you have so many cryptocurrencies coming out with new utility, new kind of great ideas and innovation, it takes a while for the regulators to catch up. And so they pick and choose. The lowest hanging fruit is the one with the biggest balance sheet, and they can make the best example of if they want to go out and try to crush it because they're maybe deemed as a security, or the administration who's in power doesn't like what they're doing.
Just one general question, but do you have any particular feeling about like external hardware storage devices? Like, so say, for example, like Arculus, like a card, or cold versus hot storage, that kind of thing. Do you have a theory or take on it?
The interesting thing about blockchain networks and crypto in general is they require perfection of users, which we know is an ideal but not a reality, right? So it's really down to you is, what do you think you can remember the best? Can you remember 12 seed words or 24, right? 20% of all Bitcoin they think is lost. to people who don't have private keys or don't remember the passphrases to their private keys, right? So it's really about what do you think you can do with our network and what we do. We have, amazing levels of sophistication around what we do with security. We have backups to the backups to the backups and all these other things. But as an individual user, you need to determine what's best for you. Hardware wallets are great, but they're a little clunky and they're not online, they're not immediate. And so if you're not using your crypto all the time for other things, probably hardware wallet's a pretty good option.
Aaron, thank you very much for your overview today and sharing a complex topic in very simple terms for us to understand.